Is it better for you to own your home or rent your home? You'll learn some things today that you've never thought about before. A full 18 considerations with some real surprises in the own versus rent conflict. And look, I'm not a realtor that makes a commission from selling you a home, so relax and settle in for unbiased information that you've never heard before that is going to help you make what is often the biggest financial decision of your entire life. These 18 fact-based points should really, finally, be your ultimate resource in making the decision, the trade-offs to help you consider which way you're better off, including why paying rent is not the same as throwing money away. Yeah, though that's not a popular opinion, we're going to look at why that's the truth. 2, you're going to understand everything by the end of this video. For example, if you think that buying a home is better, are you factoring in that in 8 years you might have to spend $15,000 just to repair your entire roof that leaks? Most people don't factor that in. Hi, I'm Keith Weinhold, Get Rich Education founder, Forbes Real Estate Council member, and longtime real estate investor. Most people think that owning a home is a financial asset, but that is not true. In fact, the top-selling financial author of all time, Robert Kiyosaki, someone that's been on the Get Rich Education podcast with me 4 times, he says a home is a liability, not an asset, because an asset puts money into your pocket every month, and a home takes money out of your pocket every month. All right, well, in strict financial analysis, though, a home is an asset, but Kiyosaki is right in that a primary residence is a cash flow drain for you. You're just going to keep throwing your money at it month in and month out. But is renting a bigger cash flow drain for you? So as we lead up to the big 18 rent versus buy factors that you must consider, some people do say paying rent is like throwing money away. I mean, you've almost certainly heard that before. Paying rent is like throwing money away because at the end of the month, well, what do you have to show for it? No, I strongly disagree with this. This is not true. I mean, look, you might have just spent, say, $800 to rent an airplane seat to fly on as you cross the country for 6 hours. But when you do that, you didn't lament about throwing that money away. Plus, an airplane seat is not as necessary as a place to live. But see, you enjoyed the benefit of using each item, a home and an airplane seat. The airplane seat gave you the experience of enjoying Boston or New York City's Rockefeller Center or Times Square or Yellowstone Park or visiting your family. Though neither the home nor the airplane seat provide you with a tangible financial return, you got an experiential return, your return on life. Although owning a home is rarely a good strict financial investment, you still tie up a lot of money in your humble abode. And first, understand that you basically have 4 choices in how you live. You can own your home, pay rent to a landlord, you can be homeless, or you can live with your parents. But really, it's basically rent versus own. Now, it makes sense to rent more often than a lot of people think. In fact, more people are renting. The current U.S. homeownership rate is 66%. It's down from 69%. 69% was the recent peak in 2004. As you take a look at the history of the American homeownership rate here, understand that I expect the homeownership rate to fall in the near future. And of course, that's because the cost of homeownership has soared in recent years due to higher home prices and higher mortgage rates. This means that more Americans are being taken out of the homebuyer pool and added into the renter pool. So then, here we go. The 18 factors in your rent versus own decision, many of which you've never thought about before. Number 1 is time, your most important resource. Do you really want to spend any of your weekends at Home Depot or Lowe's, or evenings online researching how to fix garage doors or fixing leaky faucets with pliers? Well, homeowners are going to do that, and it isn't just fixer-upper type homes. In order to avoid feeling like you're living in a dated home, you might need to upgrade your kitchens and bathrooms every 15 years. Now, you could enjoy doing that sort of thing, but whether you do do or not, it's how you're spending your one finite, irreplaceable, irreplenishable resource in this one life on earth that you have called time. The second consideration is choice. There are more homes for sale than there are rentals, especially at the higher end. But really this, like all things real estate, that's going to vary by your chosen geography, and more homes being used as short-term rentals like Airbnbs and VRBOs, that makes the pool of both homes for sale and long-term rentals shrink. The third consideration is equity buildup. Now, okay, this is going to be a real paradigm shift for you if you're new here at Get Rich Education. Equity is the difference between what your home is worth and how much you owe on a mortgage. So if you've got a $500K home with a $300K mortgage on it, then you've got $200K in equity. Homeowners build equity, renters don't. And that matters. But here's what you may not have expected to hear. Home equity is an awful investment. Your equity has zero rate of return always, because the presence or absence of home equity, it has nothing to do with whether or not your home appreciates. And additionally, with your earlier mortgage payments, most of it goes toward interest, not principal, and your interest payment alone could be higher than a rent payment for a like property. And if you don't understand why the rate of return from home equity is always zero, which is really shocking for some to realize for the first time, I'll put that video right up here for you. The fourth of 18 rent versus own trade-offs is liquidity. Although most homeowners build equity, that equity is difficult to access. To tap your home equity, you've got to prove to a bank that you qualify again, and then perhaps wait months and incur costs, and you still might be denied access to the equity. You can't access your own money because it's not so much your own money, and that's why houses make terrible banks. Alternatively, renters stay liquid, and if a homeowner makes an extra principal payment to the bank, or really any principal payment at all, and you want to get that money back out, they're the ones in control of that, not you. So making any principal payment to the bank, a regular ongoing one or an extra one, that's like saying, hey, Mr. Banker, here's an extra $1,000 principal payment. Don't pay me any interest on it. If I need it back, I'll pay you fees, and I'll prove to you that I qualify again. So home equity is illiquid. The fifth rent versus buy trade-off is opportunity cost. Many homeowners immediately tie up a 20% down payment in their home, although you could use a down payment as low as 3%, and there are some even newer 1% down payment programs in a few select states, but they'll typically come with you having to pay an extra few $100s a month in a mortgage insurance premium if you make less than a 20% down payment on a conventional loan. And again, any down payment dollars, that's equity, so they're illiquid dollars with zero return. Instead, your chunk of money could actually be earning a return for you somewhere else. The sixth consideration is called sunk cost. It's an overlooked killer for homeowners. Homeowners sinking money into the property, most of which they'll never get back again. When you buy, you'll have mortgage loan closing costs on that purchase day, and then over the years, constant home maintenance and repairs, property taxes, utilities, landscaping, HOA dues, replacing pipes, repairing roofs, snow removal, roofing, painting costs. All these things are never fully recouped, and renters simply bear fewer of those sunk costs. And down the road, when you go to sell your property, you might pay a realtor a 5% commission. That's a percentage of your sales price, but that might mean you lose 10 to 20% of your equity. Yeah, say that you sell a $500K home with a $300K loan on it. That's $200K of equity that you have, where your realtor commission is 5% of the $500K home. So that's a $25,000 commission that you'll have to pay from your $200K in equity. Well, you just lost 12.5% of your equity that you might have paid into for 10 years or more. That's 1/8 of what you worked to build up. Next is the seventh consideration in the dilemma: should you rent your home or should you own your home? And by the way, at the end of all 18, I'm going to give you a conclusion here, what I would do myself and what I do myself. I've got some really important rent versus own points coming up, including a bunch that you've never thought about before, and you need to. Hey, go ahead and drop a like here on the video if you're learning some fresh perspective. I'd really appreciate the thumbs up. The seventh of 18 considerations is control. For some homeowners, the peace of mind in knowing that a landlord can't tell you to move is priceless. You have an anchor. This home is yours. You can paint a wall or even knock down a wall. You can renovate your kitchen or add a fence. Make it yours. Homeowners have the control advantage. The 8th is appreciation. Renters don't experience price appreciation, and even worse, they might have to weather rent price increases. Homeowners with loans benefit from financial leverage, which amplifies wealth in an appreciating environment, even faster than compound interest does. And inflation becomes a friend to mortgage debtors because it helps you silently pay down your loan balance. That's something that very few people realize, and that's because your principal and interest payment stays fixed for up to 30 years while your wage tends to rise. And of course, home values can deflate too, but that's not common. The long-term trend, decade after decade, that tilts strongly toward home price appreciation. The 9th trade-off are tax advantages. Homeowners often receive a mortgage interest deduction and perhaps some other advantages like adding solar power cells, but many homeowners take the standard deduction anyway. The 10th is mobility. This is a real advantage for renters. Renting keeps you nimble. If you get a new job opportunity or a life change like marriage and kids, your mobility is an asset. And on the other hand, homeowners eventually sell and are then beaten up with the sales commissions that I already mentioned and the make-ready repairs. And we're not done. If you sell a home, you've also got one-time seller-side closing costs to pay too, all coming out of your equity. The 11th of 18 considerations are mortgage rates. If you maintain good credit and you live in the United States, you are just in so much luck with mortgage rates long-term. In Canada and elsewhere, you can't do this. That is, in America, you can tie up very long-term fixed interest rate debt with a purchase now, and in a few years, if rates go higher, well, you'll just be glad to keep that 30-year fixed rate mortgage. You're going to be glad you have it. And if rates go down, you get to refinance and lower your payment without having to reset the likely lower home price that you paid years earlier. So if you own a home and maintain good credit, you can play both sides of the mortgage rate game. The 12th consideration is rent to price ratio. If a home costs less than about $350,000, that tilts toward owning it. If it costs more, that tilts toward you paying rent. And if the monthly rent is $600 to $700 per 100K worth of home, rent it. And if it costs more than that, own it. Regionally, it makes more sense to rent on the US coasts and own in the heartland. And there are certainly numerous regional exceptions to such a general rule of thumb like that. Renting is the better deal for you if you're in Manhattan or Brooklyn or San Francisco, because there you can pay perhaps $300 of monthly rent for every 100K that the property is worth. And in low-cost inland places like, say, Little Rock, Arkansas, if you're renting a single-family home, you'd have to pay perhaps $900 worth of monthly rent for every 100K that property is worth. Also, be a landlord in Little Rock or Memphis because you're getting $900 in rent for every 100K of property you own. But in New York City, don't be a landlord. You're only getting about $300 there. The 13th consideration is community formation. Yeah, getting a little touchy-feely here, but owning your home provides you and your neighbors with a feeling of belonging. Homeowners have more interest in looking out for the common good of the whole neighborhood, and that's the kind of thing that helps everyone. People feel more fulfilled when they're part of something that is greater than themselves. So owning your home, it makes you more anchored in a sense of community. The 14th rent versus own consideration is travel. This is so simple, yet everyone overlooks this. Have you ever been to New York City, Chicago? What about Arizona, Florida, Alaska? Have you ever been to Spain, Ecuador, or Peru? I mean, you can't travel everywhere, but if you haven't even gotten out to see the very world that you live in, well then how would you know where you want to live? And if you haven't yet traveled much in your life, consider renting until you found the geography that fits your interests. The 15th of 18 considerations, rent versus own, is that of personal cash flow. If it costs you substantially more to own a place rather than rent that place, well then rent it, and vice versa. Homeowners that divert too much of their income into a mortgage payment, they're what's known as house poor. Well, this stifles your opportunity to travel and invest and provide opportunity for your family. So don't get trapped into being house poor just because you can stretch to barely afford a mortgage. Live a good life. You want to live well, and you want to have an emergency fund too. Now, when you do qualify for a mortgage, your mortgage loan underwriter, they can be a check on making sure that you can afford the property, because you'll need to have a low enough debt to income ratio and some reserves. But if the lending environment loosens up, you can still get into trouble by becoming house poor. The 16th consideration is natural disasters. Areas subject to frequent earthquakes, hurricanes, and floods. That clearly tilts to the renter's advantage. Even if you're adequately insured as a homeowner, these catastrophes are worse for you, a homeowner. If you're a renter, have renter's insurance. Look into that. The 17th is consumer advantages. Owning instead of renting, that can give you higher credit card limits and more favorable insurance rates. And the 18th and final consideration is pets. Homeowners have the upper hand here. You can build a fence or a pen for your pet, and some landlords only allow certain pets. Well, there they were, the 18 rent versus own considerations. Consider that your housing payment is often your life's biggest expense. You're going to be making it month after month, year after year. If you stay in a property all 30 years, that's 360 months worth of payments that you would need to make. So it's worth thinking this through, being strategic, and running some numbers. But now you know what all numbers to run, and now you know what's more important than the numbers. It's about the lifestyle that you want to live. And when people say something like buying a home was the best investment that I ever made, be careful. They usually didn't consider all of the ongoing costs. And yes, there's still a decided stigma with renting, but you don't live your life for the Joneses. You live it for you. Your life is meant to be lived. That is on your own terms. So what's the bottom line with what makes the most sense financially, just strictly financially? Well, because higher rent amounts don't rise proportionally with higher home purchase prices, it's often better for you to be a renter in a high-end home and then actually buy low-cost income properties that you rent to others. Yes, you're paying rent to a landlord in a high-end home, and then the best investments are typically low-cost homes in the Midwest and Southeast that you rent to others. If you're ready to buy, we help you buy exactly those types of rental properties, often in the Midwest and Southeast, with our free coaching at gremarketplace.com. Hey, if you like learning like this, download the free Get Rich Education mobile app. That's where you can hear my audio-only podcast, or just listen to me every week through Apple Podcasts and Spotify on the Get Rich Education podcast. Here's hoping that you found rent versus own considerations that you've never thought about before. Hey, I'd really appreciate it if you click the share button. If you think that others would benefit from this video, the share button is right beneath the video here. That allows me to reach and help more people. I'm Keith Weinhold. I'll see you next time. You can watch this one next.